We still believe that the average household will continue to have a tough 2010. So as you say, inflation rates are looking better, but I think general cost increases are still with us. We've seen rising electricity rates now also on the cards. And if it's not mitigated by reasonably good salary increases for the public and private sector workers in South Africa, I think we may have to look towards 2011 really for a full-ish recovery of the ordinary household disposable income position.
Of course, your focus really is on the lower end of the market, going up to the middle end of the market, so people who really have been affected by last year's recession.
Oh, man, most definitely. I mean, specifically also job losses. The South African economy almost saw 1 million job losses during the year. We don't really see that yet being recreated or even starting to. So, and a lot of the job creation capacity that was riding on the back of the World Cup, I think is easing or switching into a different sector out of construction, probably into more the tourism and the entertainment side for a while. So whilst that will all contribute to a positive spirit, I think, in the country, the real money flows, I think, will remain constrained for a while longer.
Of course, direct marketing challenges also appear to have been an obstacle for the group during the year, contributing to the fall in business insurance. How's that been addressed at the group?
About middle of last year, we slowed down our direct marketing sales activity quite considerably, and towards the end of the year, we almost slowed it down completely and stopped it. It is a difficult channel in the current market conditions, selling into a market segment that it's a low commitment sale with a small premium. And we've really struggled with persistency really on that business line. So from a viability perspective, we really need to reshape that end of the market before we decide to continue.
Of course, direct marketing was something that was introduced more fully a couple of years ago, really because it was quite cost effective for the lower end of the market. Is this something that you will be bringing back in full force once conditions have normalized?
Certainly, I think an alternative distribution channel into the lower end market, considering the regulatory challenges and it's getting more expensive to distribute through more the traditional distribution channels. Having more channels reaching that end of the market will be important. I think from a regulatory perspective, the government's also trying to lessen the burden there with introduction of microinsurance legislation, etc. So if that takes shape, maybe there will be a better opportunity to actually address that market in a more viable manner.
How would that microinsurance legislation affect a group like Metropolitan?
It probably would open up more opportunities. It'll allow you to access markets maybe a little bit on a lower cost basis. It probably also could regulate an extent of the market that's sitting with informal burial societies, etc. That's operating in the informal market. That we can then be partnering with. So I think there will definitely be opportunities through a well-crafted microinsurance legislation.
You also talked just in the retail business about a change in the mix on new recurring business, really from savings policies to risk policies. And I presume that's an indication of how tight conditions were for your customers. What are the margins like on the risk policies compared to the savings policies? Did that put pressure on margins?
Probably the pressure on margins came largely from the investment business. Given the introduction of new commission structures and also the introduction of minimum surrender values, which is kind of the tail-end implementation of the statement of intent that was agreed a couple of years ago, margins on investment business reduced considerably. So we're currently sitting probably with two tails, and good risk performance, good sales and reasonable margins. And then from a production perspective, on investment business, less thereof, and also then obviously coming in at lesser margins. In the longer run, I do believe that maybe that certainly customer value has improved throughout the process. So if it reshapes the industry, it's not too bad, and I think we will be at a better place in future, maybe of lower volumes. And if the businesses can align their margins to then to pick up again, we probably have a more sustainable, longer-term investment proposition for insurance clients.
How do you recover these margins going forward, though?
Obviously by selling more always helps. So, but there's got to be a viable business proposition the client need on the other side. So you've got to get your agents trained to make sure that the needs analysis are done appropriately and highlight where appropriate. An investment policy can solve that need. And then obviously the big one that's really clearly under control is the expense base. We have spoken about our retail business, which is the largest business in the group, about needing to bring it to lower cost. We are probably one of the lowest cost, highest volume operators in the market, but we are talking even of lower cost. And I think from a savings perspective, those are your critical elements that you need to improve to actually improve your margin.
Of course, we know the retail customer was under particular strain last year. How about corporate business? What was that looking like?
Our corporate inflows last year, although maybe slightly constrained, we're very happy with. Certainly I think the corporates probably felt the strain a little bit before the individuals. What particularly we saw is that from benefit payment perspective, so this is really caused by the mobility in the labor market. This is retrenchments, boarding of people for ill health, etc. A steep spike in terms of that, obviously then affecting some of your risk experience on the underwriting side of those benefits. However, we do see that slowly normalizing. So I think the corporate shakeout is probably coming to the end. New business acquisition on the risk side for us, and certainly on the administration side, where we try to build a business of bigger scale, has been, I think, on expectation. However, investment side is we've got a renewed focus in certain product lines to actually lift our investment new business flow.
Perhaps just in closing, maybe chatting about the health business, because that appears to have been the highlight of the results. Operating profit before tax up 8%, strong growth in the government employees medical scheme. Can we sustain growth of this rate, though, in the health side of the business?
We've got certainly the growth in GEMS, as it's called, has been instrumental to the growth and membership of MHG. I think for principal members, we're now about 855,000, just over 2 million beneficiaries. So it's certainly a big business now from our perspective. We are striving to keep costs low. Again, we are probably the lowest cost operator of scale in that sector of the market space. I think we've got further growth. We probably need to extend our managed healthcare offering. I think that's probably an area where we're trying to look a little bit further. And I think there's further opportunity to consolidate off our very low cost base. So, we need to incrementally increase margins, but not at the expense of excellent maintenance of our service levels. And I think we've managed to find a good balance between the two. And
just briefly, prospects for 2010, another tough year. You're saying 2011 is likely to see the full recovery in the business?
Yeah, certainly. I mean, we are planning and budgeting for 2010 to be a cautious year. Obviously, we are well positioned from a capital base, etc. So if things start looking more predictable, we are ready to put a big front foot forward. But I think the realistic expectation is that it's all hands on deck for 2010 to get through a solid year.